Skydiving? Climbing the Eiffel Tower? What's on your bucket list? Today, we discuss the 3 financial things you need to do before you kick the bucket. Then, how can you raise capital for your business? Why should you get life insurance? All this and more on today's episode of The Wealthy Life. Welcome to The Wealthy Life. What's on your bucket list? Well, there are a few important financial things you need to do before you leave this world, even if you're not ready. Financial advisor Pam Katnar joins us today to share her wisdom on this topic. Pam, thanks for joining us on The Wealthy Life.
Thanks for this opportunity. I love what you do with the financial education on this show, Sybil.
Well, that's
so
great.
Thanks.
I think you share the same passion.
I do.
You've been a financial advisor for close to 2 decades, and you've seen people go through all kinds of life experiences. And obviously, when it comes to passing on, we all know we're going to go, but we're not always prepared for it. What are the 3 things that you think people should do before they, kick the bucket?
Well, there's probably a lot of life things they need to do, but from a financial perspective, I think it's most important to get your legal documents done, get your financial affairs in order, and then have an opportunity to make peace with yourself and your friends and family, Sybil.
Oh my gosh, those are so simple and so obvious, but most people overlook them. Let's start with the financial documents, or the legal documents, actually. Let's start there. What legal documents do people need?
So there's 3 basic ones that I would say. First of all, make sure that you've got a will done. And in that will, you will also name an executor. It can be more than one. And the other thing I want to make sure that we mention here is that the laws around this whole topic they vary from province to province. So it's super important if you've moved recently to a different province that you take in your legal documents to a local notary or lawyer and make sure that they are valid in the province that you live in. So
good advice.
Legal documents, then your will, and then your power of attorney. So that's defining who you can lean on for help for your business affairs if you're not capable of dealing with them yourself. So you're very much alive,
yes,
but you need to lean on somebody. So who is that?
Right, because at the later years or that later stage in life, maybe you're critically ill, can't make those decisions, but you're still alive, so you need the power of attorney. Absolutely. Then when you pass away, the will.
Absolutely.
And only 50% of Canadians have a will.
I know.
It's crazy.
It's not good. And that's, there's that reluctance to get this kind of stuff done, but I always reassure my clients and people that I'm speaking with that I've got lots of people who have had their will done and they still live for a very long time. So it doesn't mean instantly it's going to be over just because you get this done. So
I always say the opposite. It's Murphy's Law. Have your will done and then you'll live many, many more years to come.
That's true.
If you don't have it, that's when something happens. It's kind of like insurance.
Absolutely. And the third one that we want to make sure that people have done is the letter of representation. Again, it can have a different name in different jurisdictions, but that is assigning who for health. And it's not the end of life kind of stuff. It's like the ongoing living decisions, like in my dad's case when he needed a wheelchair or he needed his medication changed.
Right.
Parkinson's had taken its toll and he wasn't he didn't have the capacity to make those decisions. So he leaned on his daughters to make sure that we could help him with those kind of things.
Well, the good news is you can get all of those done at the same time.
Absolutely.
So just go in and get it done.
Exactly.
Let's talk about the financial affairs in order. What does that really mean?
I know, that's a big topic, but some of the things that we talk about in that regard would be making sure that you've got beneficiaries designated on your life insurance policies, on your TFSA, on your RIF, on your RSP. Making sure if you are financially responsible for people, that you've taken some planning steps to make sure that if you're not around, that they're still going to be cared for. Also, just make sure that your executor, whoever's going to actually play this important role, knows where the original documents are.
Oh my goodness, that's probably the most important thing. So many people just have things stashed everywhere and nobody knows where to find them. So part of having your financial affairs in order is making sure that they're in one spot, everyone knows where to find it.
Exactly, because in today's world, a copy doesn't do you much good. You need to know where the original ones are.
Yes.
And we also recommend that people, I say, dust them off every 3 to 5 years once you actually have them done.
Yes.
And just make sure the cast of characters that's involved is still, the people that you want involved.
Yeah,
so those are some of the things.
We've got a helpful tool for that, but we'll get to that a little bit later. Yeah.
The other thing I would say is spend some time with doing some tax planning. Most of the people that I know are more interested in their results of their hard effort, work, and their lifetime achievements, going to friends, family, charities, than just a general contribution to Revenue Canada.
Yeah, I would say most people would put Revenue Canada on the bottom of the list if they have a choice.
Exactly.
And that may be the case if you plan ahead, but if you don't,
exactly. Yeah.
your money may not go where you want it to go.
Some planning is really in order. And again, every situation is unique, so there really needs to be some time spent on an individual basis because your family situation is going to look different than everyone else's.
Now, I want to just touch real briefly on the third one because I think this is important about making peace with friends and family. What does that look like?
Absolutely. To be able to have some peace of mind is to have those conversations with friends and family, both things that you would want them to know before you left, and also to give them an opportunity to say things they might need to have. So everybody can sort of have a peaceful exit and have some closure around, around this passing. Just peace of mind.
Oh my gosh, that is just wonderful. Those 3 things are fantastic tips. And if people don't know where to start, contact us at thewealthylife.com because we've got this estate planning booklet that you just fill out and it keeps everything in one organized place. Pam, thank you so much for being on the show.
There's one other thing I want to point out is make sure that your digital footprint is also taken into consideration here as well.
And that's in the booklet.
Absolutely.
Good point. Thanks, Pam.
Thank you, Sybil.
And when we return, find out how to raise capital for your business.
The Wealthy Life is brought to you by investment dealer Raymond James. Life well planned. See what a Raymond James advisor can do for you.
Do you need money for your business? Securing financing is a challenge for many business owners. Investment banker Sean Martin explains a few different ways to get the cash your business needs. Sean, welcome to The Wealthy Life.
Thank you for having me, Sybil.
So Sean, what is an investment banker? What do they do? Tell us about your job.
Yeah, I think the best way to describe it is an investment banker is an advisor for businesses or corporations. Just like as individuals, you would have a financial advisor advising you on your wealth and your planning. Businesses and corporations need that same type of advice. It's obviously more complicated and more dynamic, but that's essentially what investment bankers do is provide that advice to businesses.
Great, and I think a big part of that advice is how to raise capital. What are the most common ways that business owners can access some capital?
Yeah, there's two primary sources of capital that a business would access, essentially being debt and equity. If someone's borrowing money in the form of debt, the most traditional way is bank debt. A lot of small businesses do borrow money from their local bank.
Right.
In the last number of decades, there's become dozens of more ways to borrow money through private credit solutions. So larger businesses have access to other forms of debt, not just bank debt.
So maybe expand on that a little bit. What do you mean by private sources of debt? If you don't go to a bank, where else would you go?
So again, for larger businesses, there are now, globally hundreds, if not thousands, of investment management firms that instead of investing in like public companies, they invest in private credit. So they're lending money to other corporations, and those loans are essentially investments from that private credit perspective.
Right, and am I correct in assuming that the interest rate may be higher on that than they would normally get through a bank?
Yes, absolutely. Traditionally, a bank credit facility would be your lowest cost of capital, and it goes up from there. There'll be private credit solutions that are just a little bit more expensive than a bank.
But there's a reason for that, isn't there? What's the reason why the interest rate is different?
Yeah, the banks are funded essentially through deposits. bank accounts, GICs. So their cost of funding is significantly less. So they don't have to charge as much when they're lending the money out. Whereas these private credit funds, they are targeting a higher rate of return, sometimes 6%, sometimes 10%, sometimes even more. And so for riskier loans, they're charging higher rates of interest.
Right, but it's an option. So if a business owner is struggling to get the credit they need or borrow the funds from their financial institution, their bank, then they may look at other options, but they're going to pay a little bit higher rate because for the lender, it's a bit higher risk. So that's on the debt side. Let's talk a little bit about the equity side. What's involved in that?
So the equity side is, again, there's a number of different routes or options to source equity. From a private perspective, I'm sure most business owners have heard of or dealt with private equity firms. And so for larger businesses, private equity is another great option, either to just receive an investment, sometimes for a minority stake in your business, or sometimes businesses will sell a majority, if not all of their business to private equity. And then the other option from an equity perspective would be the company itself actually becoming public. So the business doing an IPO in order to raise capital from the public markets.
Which I know a lot of business owners would love that, but not everyone would, because when you go public or when you issue shares, you actually give up a lot of control. You now have to report to a board of directors, your shareholders. You can't just make those decisions that you want to make. But it is an option, and some people, if they've got a great idea and they just need the money to fund it, sometimes they don't have a choice. Would that be the case in some of the deals that you work on?
Yeah, I think that's right. I mean, the beauty of raising capital and corporate finance in general is like you really start with a blank slate. Every situation is different, but there's so many different permutations, especially as you become larger. There's lots of combinations from all these things we just talked about as well. People can, raise debt and equity at the same time.
Right.
But yeah, when you're thinking about equity capital, a lot of it has to do with control. Just like you said, how much control do you want to see? And also what is the cost of that capital?
Right, because if the cost of borrowing the money to invest in your business exceeds the benefit you're going to get out of investing in your business, it's probably not worth proceeding. And I think for smaller business owners, one of the things they might want to consider when borrowing money from a bank, if their business on its own doesn't qualify, they can use their own personal capital and equity as collateral to borrow that money. Well, Sean, you've given us lots of great things to think about here today. Really appreciate you coming on the show.
Thank you for having me, Sybil.
And coming up, there are 3 reasons you need life insurance. Find out what they are after the break.
The Wealthy Life is brought to you by investment dealer Raymond James. Life well planned. See what a Raymond James advisor can do for you.
Do you have life insurance? Life insurance specialist Uriah Kane is here to tell you the 3 reasons you need it. Uriah, welcome to the Wealthy Life.
Thanks for having me, Sybil.
Now, as an insurance specialist who I assume has been doing this for some time, we won't give your secrets away. What are the 3 reasons people need life insurance?
Yeah, thanks for the question. Typically what we're normally seeing is reason number 1, or people are being encouraged to consider insurance, is if they're looking to purchase a home, they've taken on some debt with a mortgage.
You mean they don't want to die and leave someone with a big debt to pay?
Not normally, no.
Well, no one wants to die, but
No.
they definitely don't want to leave their loved ones with a big debt, a bill to pay.
Exactly, yeah. So it's pretty common for people to be approached about considering getting some life insurance to pay down debt in the event that something happens.
Especially, I'm just thinking, especially young families.
Especially young families.
You know, if one partner goes and you've got a big mortgage and you've got kids, okay, so definitely good reason number 1.
Reason number 1, yeah. Reason number 2, replace income. I'll use myself as an example. I commute back and forth to work, and if something were to happen to me at this point, we've still got a family with some kids at home, And knowing that there was some insurance in place that could be used to replace my income in the event that something happened is a second reason why people typically consider getting some insurance in place.
Income is a big one. If you think someone making $50,000, $100,000, $200,000 a year, and then all of a sudden it's gone, that's a lot of money to have to replace for the surviving members of the family.
Exactly. So a general rule of thumb is anywhere from 10 to 15 times annual household income is kind of a rule of thumb that we use across the industry for getting adequate insurance in place in the event that something were to happen to either spouse in the family.
Okay, so viewers, check and see if you've got 10 to 15 times your annual income in life insurance. Great. Now let's talk about the third reason.
Yeah, so reason number 3, if I was to summarize it, I would suggest that life insurance as an advanced financial planning tool is really where I spend most of my time.
Ooh, I like the sounds of this.
Yeah, so I'll give you a couple of examples of what I mean by that. It's not uncommon for us to see people who are really philanthropic in some of their goals and aspirations going forward and wanting to maximize their estate by using life insurance, which can then be donated down the road, is a pretty common practice in advanced estate planning, depending on kind of the client file we're working on.
So you mean donating it to charity?
Exactly,
Yeah.
yeah.
So if charitable giving is really important to you, and I know a number of people have charities as part of their estate plan.
Exactly.
Tell me a little bit about how they would use insurance for
Yeah,
that.
so there's a couple of different ways you can set it up. One, for example, is the life insurance. Once it's in place, those individuals can name a charity or foundation that they affiliate with or have a soft spot in their heart for, and they can name that charity as one of the beneficiaries to benefit from that future death benefit. That's scenario number 1.
Wow.
Scenario number 2 is we can see a situation where the life insurance policy is donated to that charity or foundation, and that triggers some tax credits and benefits on the front end for the individual donating the policy. So the foundation.
Okay, so let's pause there for a minute. So if I bought an insurance policy that I wanted to give to the charity, then I might be able to deduct the payments along the way, or there might be some tax benefits to me now
Exactly.
while I'm alive, and then when I'm gone, the charity gets it.
Yep.
Okay,
Yeah.
tax-free.
Tax-free. Yep.
Okay.
So there's a couple of advantages to how we can set it up that way, where there can be the potential for some additional tax benefits, credits, deductions, depending on how it's structured for that family.
Great. So you mentioned there was a couple of other scenarios for wealth planning.
Right. Yeah. So 2 other scenarios that came to mind, as we were kind of preparing for the conversation today. A lot of my time is spent in the next 2, which is looking at the tax advantages, especially for business owners who've accumulated wealth inside their private companies. It's a lot of my time right now is spent in that area specifically.
Yeah.
And as their assets accumulate in those private companies, either in the active business they're in or passive investments and other things as they build a nest egg for retirement, they have a tax on death and a tax on growth issue as those assets accumulate inside of that situation.
Right.
And
so how do they get it out? How do they fix that?
Yeah, good question. So one strategy, not the only strategy, but one approach in some cases where it makes sense is we can look at setting up a life insurance policy and not only just having that structure in place, but customizing it in a specific way. We can actually start overfunding it to start building an investment inside of that insurance structure I'm referring to. It's owned by the company. The company is the owner, the payer, the beneficiary. The business owner is the life insured.
So the key in that is they move money that would be normally taxable into a tax shelter, because overfunding a life insurance policy can act as a tax shelter for some money.
That's exactly it. So there's a lot in that landscape though, and so that's really the reason why my specialization exists.
And let's touch real briefly on the last one, and then we'll be out of time.
Sure. So the last point is simply the ability to transition those assets intergenerationally out of the corporation to family or charities or foundations that the business owner supports because of something called the capital dividend account. So all of those different reasons are important depending on the client and the situation that we're working in, but all of them are reasons for considering life insurance.
Okay, that is a lot of information to absorb. The first 2 are super simple.
Super simple.
Pay off debt and cover loss of income. But when it comes to wealth accumulation and wealth planning and legacy planning and estate planning, there's some tricks up your sleeve that I think people would benefit from. So thank you for sharing that.
Thank you.
For those of you out there, highly recommend, you want to learn more about this? Meet with an insurance specialist. You can get the full scoop. Uriah, thank you.
Thanks for having me.
And don't go away. Learn how to pull funds from your retirement account tax-free when we return. Welcome back. Thanks for your emails, tweets, and messages. Today's question is from Russell. Dear Sybil, I am retired early at the age of 55 and am living off dividends from my investment portfolio. I don't have a pension, but heard I may qualify for the pension tax credit if I convert my RSP to a RIF. Is this a good idea? Well, Russell, congratulations on being retired at 55. I hope you're finding some fun things to do with your free time. This is a great question you ask, and the short answer is yes, you do qualify or should qualify for the pension tax credit. So what is this pension tax credit? Basically, it's a tax credit for up to $2,000 per year of eligible income. And eligible income includes things like a government pension, a work pension, or a RIF pension, income you pull out of your RIF account. So seeing as how you don't have any other pension income, you may want to convert a part of your RSP to a RIF, pull $2,000 from your RIF every single year so that you get that corresponding pension tax credit. It's essentially like getting $2,000 a year out of your taxable income for free, no tax. Great way to do it. Now, this only works if you don't have any other pension sources, and you need to look at cra.ca to find out which pensions qualify and which do not. Now, even if you don't need to spend the money, I recommend looking at this strategy, because if you pull the money out tax-free, you might then use that money to plug into a tax-free savings account, or put it into a non-registered investment account, or since you're so young, maybe you still have some unused RSP contribution room that you could put it back into an RSP and get an RSP tax deduction, increasing your savings even further. So before you do anything, of course, touch base with your accountant for professional tax advice. And that wraps up this edition of The Wealthy Life, helping you make smart financial decisions. Join the Wealthy Life Club by becoming a member at thewealthylife.com. You'll get access to everything you need to live your version of the wealthy life.